Hi, this is James Eng, Full Capital, and this May multifamily financing webinar is titled Survive to 2025. And what you're going to see is we're going to go through some case studies on going from bridge loans to Fannie, HUD, even bridge to bridge on there. So we're going to start with a case study on a deal, and then we're going to talk about some of the earnings updates from lenders, owners, brokers out there, sort of public companies. I would go through their earnings calls and then dissect them a little bit and share some of the insights, and then also look at the general macro themes that I'm seeing across Trepp data, Yardi data, even new deals on the market, and then wrap up with sort of a financing update as well. So let's jump in to the Survive the 2025 webinar. In April, we saw this large foreclosure happen, 3,200 units down in Houston. The original loan amount was like 230 million, and the portfolio sold for 196. So you can see that lenders are already taking sort of a little bit of a haircut there, and the pref equity stayed in on that deal. And we're seeing even more distress. Another deal, same owner, going into foreclosure, $65 million loan this month. And then also a lot of banks are just selling off their portfolio. So if it's not performing, they're just selling it and moving on to the next guy. What's causing these issues is that essentially all these loans have variable rate and they're having maturities. Let's talk about this deal. This was a $13.5 million deal. Loan amount's 10 million right now. NOI is actually pretty good, 742,000, which is a 5.5 cap. But the bridge loan matures in December of this year. So what are the options, right, for you as an owner out there? All right, so let's look at these three options. So starting on the left-hand side, you got agency, Fannie, Freddie. Then in the middle, you've got HUD. And third, you've got non-recourse bridge to bridge. So I highlighted in red sort of the main things that you want to take into consideration if you're going into any of these loans. So you can snapshot this. And then if you want the whole presentation, definitely comment in the video below and I'll send it to you. And like the video. So, all right, so let's go. Fannie, Freddie. So 125 debt service. You got 60-day close. It's relatively low cost. It might be 2%, 2 to 3% closing costs in total. And then the main disadvantage here is the loan sizing is based on a 125 debt service coverage. If you move to HUD, they use a lower 118 debt service coverage on a 35-year AM, which is pretty good. But then it's a longer process, 4 to 6 months to close. You need audited financials, which is a higher cost, and your rate might be a little bit lower. And then your last option, really on the right-hand side, is non-recourse bridge to bridge. So this is the most flexible on DSCR. They can close in 30 days, but your rate are significantly higher, so 8 to 10%, and then your term is typically only 1 to 2 years. So let's talk through these three options on this particular deal. So if you have a 5.5% cap rate on a $13.5 million loan, or $13.5 million value, which is a 5.5, which is good. But then currently with rates at about 5.5, you can only get to a 1.09 debt service coverage on 10 million. So the problem is that your loan is 8.75 and then your loan is short 1.25 million. So it's going to be a cash in refi with agency on this particular deal. So let's move to the next one. So a lot of people are doing this, right? So a lot of people are just refining, putting in more equity and resetting their deal for 5, 7, 10 years. And that really goes along with the Survive. The 2025 is sort of make it through this little trough and get to the backside of it. All right, HUD. So HUD, they're going to use a 118 cover and they're going to use a 35-year AM. So you actually hit the $10 million loan amount. So you have no shortfall. But the main thing there is it's going to take 3 to 6 months to close. So if rates move on you, that could be an issue. And the prepayment actually starts out pretty high. So it starts at 10%, works all the way down to 1% of the loan amount over the first 10 years. And then it's 35 years fully amortizing. So we're doing some of these for larger Class A properties that people want to hold long-term. So legacy assets, we're doing a lot of these. And the last option is you just go bridge to bridge. So you got a bridge on it now, and now you're going to put it on a new bridge. And so on this one right now, you could get the full loan amount, but the problem is that your annual cash flow is going to be negative, right? Because your NOI is 742, but then your debt service is 900,000 or 800,000. And so you're going to be short every year. So you fix the maturity problem, but you don't fix the negative cash flow. So you're still going to have to feed this thing until you can exit to an agency. And what the bridge looks at when they're exiting to agency is really at least at 8.5 debt yield. So that's NOI divided by your loan amount. So on this one, once you get to 850, you can refi to a $10 million loan and you're out of the deal. So that works bridge to bridge on this particular deal. All right. So that's sort of part one, case study on options for refining out of bridge. People are in bridge loans, and people are asking like, when is the pain going to stop? Because most of these bridge loans are SOFR plus 3, SOFR plus 4%. And then most people have rate caps, and those rate caps are extremely expensive right now because the Fed has just kept increasing rates. And so we still have one more hike in us, I guess. So the market's pricing in June 14th, another hike. So we'll be 525 to 5.5 on SOFR. And everyone's hoping for a pause after that. Nobody knows. We're looking at inflation readings every month to try to figure that out. 10-year Treasury has gone on a run the last 30 days. So beginning of May was like 325, 330, and now it's 380. So that 50 basis points really hurts because essentially your Fannie Freddie loan is going to be about 200 basis points higher than this rate. And so 200 basis points plus 380, you're at 580 right now. So that hurts a lot of the Fannie Freddie business and hurts. It's going to keep pushing cap rates. I was going to show this slide or use this example, and I still might use it for my thumbnail, but this is a little bit how I feel multifamily investors are right now. They're just pushing up this huge rock up the hill, and they are definitely trying to get to the other side of this. This is 2023, and we're trying to get to the other side of the mountain and push this rock downhill in 2025. So keep that in mind as we go through some of these earnings calls, because I think what you're going to see is a theme going across all of them. So we'll go through them pretty quickly though. All right. So Walker & Dunlop, which is a Fannie Freddie lender, they saw lower transaction volumes. So yellow is sort of negative things that are impacting multifamily right now, and green is the positive, right? And so we're going to add this. We're going to summarize this at the end. But all right. So Walker & Dunlop, dramatically lower transaction volumes. They laid off 110 people, or about 8% of their staff. Fannie and Freddie, they are the only guys in the business right now, so they're increasing significantly. And I like this quote, actually. So in the financial crisis, unemployment went to 9.5%, and their loans had about 1.6%. 1.6% was 60-day delinquent in 2010. Right now, we're at unemployment 3.5%, and the Fed's trying to get us to 5.5%. So even if that happens, they're thinking their loan delinquency rate is going to still be pretty low. But remember, this is Fannie Freddie, not bridge loans, not office. All right. Walker & Dunlop also talked about the affordability piece. So a lot of homes have gone up in price. The monthly payments on a lot of these homes increased 32%. So that's with the increase in the price and then also increase in the interest rate. Let's see, Arbor, which is another Fannie Freddie lender, they said they recorded no loss on the original debt. I'm not sure how that worked, but basically they were the lender on that foreclosure down in Houston that we talked about. They're still making a lot of money on their escrows and their balances that they're holding on your money, and then also on their servicing portfolio. So majority of their money is coming from that versus a lot of originations this last quarter. And then also they asked them about the bank lending that they're seeing out there. They're saying this is the tip of the iceberg. So they're going to see banks pull back even more. Their bridge lending business is, it was doing a ton in 2021, 2022. They're not doing a lot of that right now. And really their pipeline is agency business on the Arbor side. But they think the bottom's near, but it'll take some time. And they're thinking real work is really the next 9 months, getting through the next 9 months. So that gets us into 2024, and agencies are backed up. All right, let's go over to the owners on the Camden side. So this was key. So they survey all their residents when they move out, and only 10% were moving out to buy a house. And that is the lowest level in 30 years. Insurance expense increased 35% for them. And this is a large owner. And then they're thinking it's going to be a pretty good environment for 25 and 26 because there's not going to be a lot of new shovels going in the ground on the development side. So a lot of new stuff is being delivered now, but in 25 and 26, there's not going to be as much. During the Q&A, they asked, all right, when do you step back in? And they said, when you can buy a property for lower than replacement cost and your cash on cash is mid 5s to 6. That's when they're stepping back in. Marcus Millichap, big broker, sell a lot of properties. They were pencils down for a lot of the institutions. And so a lot of the deals 10 million under, we're selling, 10 million over, not selling. And so they're pushing out the timeline for the recovery due to the bank failures, capital availability. And they're saying anything really maturing this year is going to require fresh equity. So that might be a capital call, that might be preferred equity. Someone's going to have to come in to restructure these deals. They were even shocked about the amount of trading activity on the multifamily side was so low because of the interest rate shocks and compared to the cap rates, right? So those two things, the cap rates were so low and interest rates now are above that. So it's making it very difficult to buy deals right now. But there is no shortage of capital. So they see money on the sidelines waiting to come in, but they are starting to see the stress really from short-term loans in the last 3 years that are coming due. So that was really an update from the earnings side from public companies. I always like to listen to those calls to get a feel, make sure what I'm seeing here in Dallas is seeing sort of nationally. And it seems like that was the case. And then here's we'll get into some market reports of what we're seeing. The Fed side changes in underwriting. So the green is tightened somewhat, and then the dark green is tightened considerably. You can see this percentage, 80% of the banks out there are tightening their lending criteria. So that could be LTV, that could be debt service coverage, that could be borrower. And we're feeling that as well in terms of who's willing to lend out there right now. In terms of transaction volume, the first quarter was the lowest since 2012. And then also in Q2 of 2020, when you couldn't go outside your house. So, I mean, it's pretty light in terms of transaction volume. And then the apartment sector, they had pegged at about 21% peak to where we are today in terms of property values. Some of these other ones, office is even bigger. This actually looks over the last 7 years and sort of the run that it's gone through. It looks like, apartments have gone up, maybe 50% in total over the last 7 years, but look at manufactured housing at 280, self-storage at 280, industrial at 220. So, I mean, some of these other property types have just flown up the last 7 years, but you can see sort of middle of 21 to 22, this thing was just flying up in terms of cap rate compression. So this is one of the things out there that is a pain point for new owners right now, is really the new supply. And so you always like to look at the percentage of completions as a percentage of inventory, or completions as a percentage of inventory. And this is over 2 years. So in Texas, Austin's a big number. Phoenix, Fort Worth, those are going to be the big markets. And so when you're looking at Class A stuff, making sure you're building the new supply out there as well. And it seems like a lot is coming on in 23 and 24. That's why everyone's waiting for 25 and 26, like Camden had said. Trepp also looked at the distress. They looked at three things, which I thought were interesting. One is debt service coverage. Next was debt yield, and then LTV. So debt service coverage is really, that's just making your payment. But a lot of those were sort of artificially high because of the low interest rate. So debt yield is probably a better measure. That's NOI divided by your loan amount. And so you really want to be, most of the bridge loans, they wanted to be like 8.5. So you can see that greater than 9% was about 30% of the balance of the loans. And so 70% to me are at risk of refi or needing cash in to refi. And then also LTV. LTV is a big one. So looking at all three of those, you see that about 37 billion is at risk on the Trepp side. And most of that was coming from the CLOs, which were done in the last 3 years. Moody's had this. Cap rates are finally moving up. So we found that sitting at probably 4. This is probably a little bit skewed, but I would say it was probably sitting at 4, moving up to 5 now. So it's probably closer to 5.5. This looks a little bit skewed down. But Yardi put together a pretty good report, and it was like 80 pages. But the main takeaways here on the multifamily side, really construction financing is in short supply. So deliveries are going to be short in 2025. Bid-ask spread is wide. Distress is coming, and then transactions are pretty slow right now. So where's the opportunity? Obawa had showed this slide earlier at our speaker series, but here 2,500 properties were purchased in the last 3 years with shorter term loans, and then the DSCR under 1.05 is close to 2,500 properties. So that's where the stress is. So if you have a market that you're interested in, we can run this report and tell you the properties that have the low DSCR. So reach out to us, put a comment down below in the video, and we'll send it to you for that market. So this is one of the things that people keep coming back to, right? Is that the mortgage payment versus the rent, right? So average mortgage payment right now is $2,200 versus $1,700 on rent. So it's a big delta between the two, and that's going to keep, hopefully, people in Class A apartments a little bit longer, keep the occupancy up. But here's the other side of it, right? So expenses are going up on taxes, expenses are going up on insurance. And so that's driving a lot of your NOI today. If your rent growth has come down to 3 or 4%, but your expenses are growing 10, 12%, then your NOI today will be lower than the NOI a year from now will be lower than it is today. And so that is, besides people in Manhattan, that is impacting pretty much all these markets right now. So capital markets, this was another thing that you already pointed out. I mean, brokers are reducing costs, and construction costs have not come down yet to offset. And so a lot of people are just stopping deliveries right now. On the new supply side, these are the markets that they pointed out, really: Austin, Phoenix, Jacksonville, Miami, Salt Lake, because of the new supply. In terms of what's actually transacting in the market, so this is from brokers out there in the market, recent deals that are out there, it would be, most of them are getting done with either loan assumptions. So this is, and it seems like the magic rate is under 4. So all 3 of these deals were getting done at, the existing debt was 3.8, 3.7, 3.6, and they still have some term left on it, right? So those are the deals getting done right now. So that's probably artificially lowering the cap rate a little bit right now compared to new deals out there in the market. And the distress is coming, right? So this is, even brokers are starting to sell some of these distressed deals. This is a deal down in Houston, and the occupancy 78%. So you can't use Fannie and Freddie on this deal. You're gonna have to come in with a bridge loan at 8, 9, 10%, or a bank loan at 8, 9, 10% to buy this deal. And so you're gonna have to get a corresponding cap rate to that number to make it worth your time, worth your trouble. All right, so I took all of that and put it in one picture. So if you're going to snapshot one picture, here's your one picture for this month. You've got higher interest rates. This is on the floating rate side and the fixed rate side with 10-year treasury. You got loan maturities coming up. You got real estate taxes that are 20, 30% higher. You got insurance coming in at 20% higher. You got new supply. You're pushing up this boulder and trying to move it. But if you can get to the other side, the green stuff on the bottom, you got distressed opportunities that are coming, which is good for new buyers. Fannie and Freddie is still available compared to other property types. Cost of home ownership is high because of the pricing and interest rates, and then institutions on the sidelines. So you, as a syndicator out there, might be able to come in, buy some of these deals that you normally wouldn't have a chance at buying. So my background, if you don't know my background, born and raised in Houston, went to school in Austin at UT. I've been here in DFW since 2006 as an underwriter at GE, and then I've been on the mortgage broker side as a lender since 2015, doing about 1.5 billion in loans, and then also invested in a number of properties, probably 45 properties in the last 6-7 years. Here's a snapshot of the loan options and interest rates right now. So bank loan on the left side, 8 to 9%. We're seeing pretty limited bank loans right now. We're really looking at Freddie and Fannie in the middle, 5.5 to 6% interest rates, and then non-recourse bridge, if you have no other option, 8, 9% interest rates on that stuff. O Capital, we did about 1.2, 1.3 billion in 2022. We'll probably do a little bit less in 2023 just because of the less transactions, more refis, more Fannie and Freddie this year. But regardless of the situation, we help you throughout these different cycles and what you need to do, educate you, work with you on the buyer side, work with you on the refinance side. Here's a big conference coming up. We'll have 500 multifamily investors at the Old Capital Conference, October 4th and 5th. You can get your tickets at oldcapitalconference.com. To wrap up, subscribe to the channel, like the video, comment with any questions. If you need help with any long-term sheets, send me T12 rent roll OM, whisper price. I can get that to you. And if you want to set up time with me, complete your PFS, send it over to me. We discuss buying, selling, refinancing your next multifamily deal. And if you're interested in joining Old Capital, send me an email with your resume, and I'll see you next month.